Now speaking, Josh Weinstein, Vice President. We are continuing to invest in new products and experiences that will differentiate us from our peers. Summary: during the second quarter of 2023, Carnival Cruise Lines achieved a number of milestones, including surpassing 2019 net yields and operating income, cash from operations, and adjusted free cash flow, hitting all-time highs for bookings and customer deposits, and outpacing 2019 booking volumes on both sides of the Atlantic. Net per diems in constant currency were up 7.5% over 2019 in the second quarter, and guidance for net per diems in the second half of 2023 has been raised by over 2.5 points while maintaining occupancy expectations. This revenue growth will be significantly higher than the increase in cost guidance. Booked position for 2024 is also at record levels, as is customer deposits, which grew 26% over the prior quarter. Onboard revenues were off the charts, with over 50% of the next 12 months booked at any given time and over one-third of onboard revenues now on the books in advance of sailing. Demand generation efforts have exceeded 2019 levels, and sales volumes with travel agents are up 45%. To meet these demands, Carnival has grown its sales and support staff by more than 50%. In order to build strong profitability and rebuild its financial fortress, Carnival plans to reduce carbon intensity by more than 20%, increase adjusted EBITDA per ALBD by 50%, and achieve an adjusted ROIC of 12%. It is investing in new products and experiences to further differentiate itself from its competitors. Now speaking, Josh Weinstein, Vice President. The quarterly earnings call highlighted the strategies and initiatives the company is taking to increase revenue, strengthen its financial fortress, and become travel and leisure's employer of choice. To achieve this, Carnival Corporation has restructured its executive leadership and organizational structure, reducing shoreside staff count by 18%, consolidating corporate functions under fewer leaders, and setting up brand leads to report directly to the CEO. The company is also leveraging and monetizing its industry-leading land-based assets in the Caribbean and Alaska, expanding Half Moon Cay, and developing Grand Bahama Port to drive higher revenue yields and margins. To support their capacity growth, Carnival Cruise Line, AIDA, and P&O Cruises UK are generating double-digit percentage increases in both volume and price compared to 2019. This is being achieved through a purposeful reduction in overall capacity and strong demand outlook. Additionally, Costa ships are transferring to Carnival Cruise Line, starting with the Costa Venezia and continuing with Firenze next year. This is part of the portfolio management strategy that is contributing to Carnival Cruise Line's capacity growing 22% more than pre-pause expectations and Costa's capacity being reduced by 36%. To further improve their balance sheet, the company has prepaid over $1 billion of debt while retaining $7.3 billion of liquidity. They continue to be disciplined in making capital allocation decisions and plan to rebuild their financial fortress and shift enterprise value from debt holders back to equity holders. Lastly, they thank their travel agent partners and best-in-class people for delivering extraordinary cruise vacations and honoring the integrity of every ocean they sail and place they visit. Now speaking, David Bernstein, Chief Financial Officer. The quarter's adjusted EBITDA was $681 million, which was driven by a favorability of $108 million in revenue from higher ticket prices. Net per diems were up 7.5%, making it the highest revenue at $4.9 billion, and net yields turned positive compared to 2019. For the remainder of 2023, the cumulative advance book position is at higher prices despite headwinds from the loss of St. Petersburg as destination. For full year 2023, occupancy is expected to be 100% or higher. Net per diems are expected to be up 5.5% to 6.5% compared to 2019. And adjusted cruise costs without fuel per ALBD for 2023 versus 2019 are expected to be up 10% to 11%. Adjusted EBITDA for full year 2023 is expected to be between $4.1 to $4.25 billion, with adjusted EPS expected to be in the range of 70 cents to 0.77 per share. Total debt peaked at $35 billion in the first quarter of 2023 and is now expected to be below $33 billion at year-end. Through the Sea Change program, cash flow from operations will average over $5 billion per year during 2024 to 2026. Total debt reduction through 2026 is expected to exceed $8 billion, and the adjusted ROIC is expected to approach 12%, the highest level in 2 decades. UBS analyst Robin Farley inquired, "Can you clarify if strong bookings in 2024 indicate that prices are up year over year? Additionally, what type of price increase or per diem increase is implied in your EBITDA guidance for 26? Josh Weinstein replied, "We're projecting record levels of occupancy in 2024, with pricing that we're happy with. We've made good progress this year and still have a lot to play for. Our 3-year occupancy target is likely around 7 points below normal, but we expect to make it up in 2024. We anticipate low to mid-single-digit increases in price from 2024 through 2026, similar to the 2015 to 2019 period." Stifel Financial Corporation analyst Steve Wieczynski inquired, Josh, what is the expected yield growth and NCC spread for the Sea Change program? Josh Weinstein replied, Steve, our expectation is for low single-digit cost increases compared to the yield growth, providing a nice differential. We are happy to take the cost drag associated with increased occupancy levels. For advertising planning beyond 2024, we will have more concrete plans in the fall and there will be a difference in the growth rates of cost and yield. Stifel Financial Corporation analyst Steve Wieczynski inquired, what visibility do you have regarding the cost guidance for the remainder of the year and the returns on your advertising investments? Josh Weinstein replied, sure. We have seen success in our advertising efforts and we plan to continue utilizing it to maximize occupancy rates at the price points we desire. We're constantly evaluating our strategies and making adjustments to optimize our results going forward. Citi analyst James Hardiman inquired, can you clarify for me the EBITDA and leverage metrics needed to reach your 3-year target for 2026? Josh Weinstein replied, yes, that is correct. Citi analyst James Hardiman inquired, what is your expected net debt balance for the end of this year and by 2026? David Bernstein replied, James, our liquidity at the end of Q2 was $7.3 billion and we expect to see that decline over time. We were targeting 2 to 2.5 prior to the pause and as we rebuild our financial fortress, we aim to bring our level of liquidity down to that level. This will likely include a substantial portion from our undrawn revolver. Thus, the actual cash balance may be lower than the total liquidity figure. But we remain confident that we can achieve our goals. Citi analyst James Hardiman inquired, what is the status of the $1.7 billion in reserve funds from customer deposits and other assets? Josh Weinstein replied, we're confident that our cash position will improve significantly by the end of next year. We anticipate getting the majority of the line item back into our cash by then, with the remaining portion to follow in the following year. Wolf Research analyst Fred Whiteman inquired, do the 26 targets assume a return to China? What are you factoring in? Josh Weinstein replied, good morning, Fred. Our assets are in a good position. We've successfully moved them from the Costa brand, our China platform, to Carnival Cruise Line. The transition has met and exceeded expectations with guests enjoying Carnival fun Italian style. We anticipate being on the sidelines of potential growth in China for the next few years as our current assets are yielding more than expected. We are open to re-evaluating if the industry presents an opportunity. Wolf Research analyst Fred Whiteman inquired, can you provide a frame on the recovery of European cruises compared to North America, and how should we think about it for the second half of the year? Josh Weinstein replied, so, in the second quarter of this year, our European brands saw double-digit growth in both volume and price compared to 2019. This is a testament to our strategy of having the strongest brands in Europe deployed with itineraries catered to those markets. We saw a 10-point improvement in comparison with 2019 for our European brands, while North American brands improved, but much less than 10%. It's encouraging to see our European brands catching up and pulling forward. Morningstar analyst Jamie Katz inquired, can you discuss your strategy for optimizing pricing and managing the extended booking curve over the next few quarters? Josh Weinstein replied, good morning. Our goal is to maximize revenue when the ship departs. We have been actively selling tickets, meeting our guest demands. Each of our brands are diligently taking into account various factors such as booking curve, capacity increase, source markets and state of those markets when optimizing for the best outcome. We will not leave potential revenue on the table, however, there is a point where we must stop in order to ensure the maximum benefit. Morningstar analyst Jamie Katz inquired, can you elaborate on the reorg of the business and how it will impact operations going forward? Thank you. Josh Weinstein replied, I reorganized the corporation to gain scale in our operating units and give them the agility to take advantage of opportunities quickly. By deconsolidating, we've benefited from both a corporate level of scale and brand level nimbleness. Through 6 presidents who report directly to me, I control 93% of capacity. The remaining 7% can piggyback on larger brands, such as Cunard on P&O Cruises and Seabourn on Holland America. This has proven successful for P&O Australia when they piggybacked on Carnival Cruise Line, which are both full-year players in Australia. JP Morgan Chase & Company analyst Matt Boss inquired, could you speak to the annual EBITDA glide path embedded in your 3-year plan and what is the year-over-year target for 2024 given current visibility? Josh Weinstein replied, in 2024, we anticipate occupancy to increase significantly with corresponding yield improvements. We have the best book position in our history and the capacity growth is 5.5%, with 2/3 of that going to Carnival Cruise Line, our highest returning brand. There are still some challenges, such as not expecting a reversal for St. Petersburg trades and energy security concerns, but we do feel good about the trajectory and expect it to be an improvement compared to current levels. David Bernstein replied, just to add, going into the call, consensus was at 6.7 billion of EBITDA and this matches our annual step-up plan. JP Morgan Chase & Company analyst Matt Boss inquired, Josh, what potential areas of conservatism are not included in the 3-year plan? Josh Weinstein replied, I'm confident that we will strive to exceed our targets for this quarter. We've seen a 50% growth in unit EBITDA, and I anticipate that our ROIC and EBITDA will reach their highest levels in almost 20 years. Additionally, I am expecting margins to return to their historical norms. I'm sure that with these goals in mind, we will go even further beyond. Truist Securities analyst Patrick Scholes inquired, what is the current status of reserve funds from credit card processors and how will that balance affect debt reduction going forward? Josh Weinstein replied, yes, Patrick. We anticipate that the majority of funds to be released back to us by the end of 2024, with the rest by 2025. This increased liquidity and cash will be used to reduce our debt. Truist Securities analyst Patrick Scholes inquired, what is the current balance of 1.7 reported at the end of 1Q? David Bernstein replied, at the end of Q2, our customer deposits will be at 2.2 billion, resulting in an increase in reserve funds. Wells Fargo Securities analyst Dan Politzer inquired, what strategic changes can be made to reach the 12% ROIC target and how do you factor cost of capital into investment decisions? Josh Weinstein replied, from a strategic perspective, we're allocating our assets to focus on Carnival Cruise Line, which will now be about a third of our capacity. This is an increase from the 25% we had before our pause. We're also focusing on generating demand for all of our brands and seeing that in our booking numbers. With Grand Port not currently in our portfolio, it should take us from 5.5 million guests this year to 7.5 million. This should provide a nice boost to our business. Wells Fargo Securities analyst Dan Politzer inquired, how do you think the pricing gap and higher land-based vacation costs will impact lodging RevPAR and your pricing stability? Josh Weinstein replied, we are confident that our well-booked schedule for the next 12 months and our value gap will set us up to succeed should there be an economic slowdown. Our home porting strategy has enabled us to offer our guests a great value for their vacation dollars, even if there is a recession. Our focus on base loading for 2024 and other factors give us reason to believe that we will remain successful through this unique economic challenge. Josh Weinstein replied, thank you all for joining us today and tomorrow for our Investor Day. I'm looking forward to it.